Welcome to Essential Biz Marketing. Today's topic explores how international exchange rate systems have evolved over time. This foundation helps explain why currency stability matters in global finance. This section focuses on how nations have attempted to establish fixed exchange rate systems. You'll learn about historical efforts like the gold standard and post-war monetary agreements. These efforts aim to stabilize currencies and promote trade consistency. We will also examine attempts to create systems where exchange rates adjust more freely. The role of government intervention versus market forces will be highlighted. These lessons prepare us to understand the broader structure of the international monetary system. Let's begin with historical efforts to stabilize currency values. Nations historically sought currency stability by linking exchange rates to gold. The gold standard required currencies to be tied to a fixed amount of gold, ensuring trust and predictability in trade. However, competitive devaluations and post-war instability led to the system's abandonment after World War I. Let's begin with historical efforts to stabilize currency values. Nations historically sought currency stability by linking exchange rates to gold. The gold standard required currencies to be tied to a fixed amount of gold, ensuring trust and predictability in trade. However, competitive devaluations and post-war instability led to the system's abandonment after World War I. But this system did not survive major global conflicts. To finance wars, governments issued more currency than they held in gold, triggering inflation. This loss of confidence ultimately caused the collapse of the gold standard. A new international system was introduced after the war. The 1944 Bretton Woods Agreement pegged the US dollar to gold at $35 per ounce. Other currencies were linked to the dollar, allowing only limited adjustments to maintain stability. Let's explore how this system worked in reality. With the dollar fixed to gold at $35 per ounce, other currencies, like the British pound at 8.4 pounds per $35 and the Japanese yen at 360 yen per $35, were pegged to the dollar. This multilateral link created a stable global exchange system anchored by the US dollar. This system also introduced key global institutions. The International Monetary Fund regulated exchange rates and helped nations with balance of payment problems. The World Bank financed development projects to support post-war economic growth. Let's turn to why this system eventually failed. To finance the Vietnam War, the U.S. issued large amounts of dollars without sufficient gold reserves. This imbalance eroded global confidence in the dollar and weakened the Bretton Woods Foundation. Efforts were made to recover stability after the collapse. The 1971 Smithsonian Agreement aimed to restore fixed rates through coordinated adjustments, but the system remained unsustainable. This marked the beginning of a gradual shift toward floating exchange rates. Let's move into floating exchange rate systems. After fixed systems collapsed, countries allowed market forces to set currency values. This shift reflected a growing preference for flexibility in a globalizing economy. This shift was formalized in a major international agreement. The 1976 Jamaica Agreement officially recognized floating exchange rates as the global standard. It replaced the dollar-gold link with market-driven currency valuation. Governments didn't give up control entirely. While currencies were allowed to float, authorities could still intervene to reduce extreme volatility. This blend of flexibility and oversight shaped the new monetary order. Let's look at how most countries apply this in practice. The managed float system became the dominant model, where exchange rates move freely but governments occasionally step in. This approach balances market efficiency with stability goals. Let's examine the starting point of a managed float system. In this example, Korea maintains an initial exchange rate of 1,001 per US dollar. This serves as the baseline before market and policy forces trigger changes. Next, let's see how interest rates influence exchange rates. A sharp drop in Korea's interest rate from 5% to 1% makes domestic assets less attractive. This often prompts foreign investors to seek better returns elsewhere. This capital outflow puts downward pressure on the currency. As foreign investors withdraw from Korea, the won weakens significantly. The exchange rate jumps from 1,001 to 1,401 per US dollar in a short time. To ease pressure on the won, the Bank of Korea intervenes directly in the currency market. By selling dollars and buying won, it increases the dollar supply and boosts demand for the local currency. This intervention helps reduce volatility and restore short-term stability. Let's look at the outcome of the government's intervention. The Bank of Korea's actions stabilize the market, bringing the exchange rate back to 1,251 per US dollar. This example shows how managed float systems use policy tools to guide currency values. Now let's turn to another common approach: pegged exchange rates. Some smaller economies tie their currency to a stable one like the US dollar or the euro. This helps minimize exchange rate fluctuations and builds investor confidence. Let's explore how pegged systems work in real economies. Hong Kong maintains a fixed exchange rate of 7.8 Hong Kong dollars per US dollar. This peg provides long-term stability and predictability in international trade. But even pegged systems can face serious pressure during economic turmoil. A financial crisis in Hong Kong raises investor concerns and shakes confidence in the peg. This triggers early signs of capital flight and stress on the fixed exchange rate. As investor fears grow, capital starts flowing out of Hong Kong. This capital flight increases demand for US dollars, pushing the exchange rate beyond its 7.8 peg to 8.0 Hong Kong dollars per dollar. The pressure threatens the stability of the currency system. In response, Hong Kong's monetary authority steps in to defend the peg. The HKMA sells US dollars and buys Hong Kong dollars to reduce pressure on the exchange rate. This action boosts Hong Kong dollar demand and stabilizes the market. Let's see how the intervention pays off. Thanks to sustained action by the HKMA, the exchange rate returns to the pegged level of 7.8 Hong Kong dollars per US dollar. This confirms how strong monetary policy can uphold a fixed exchange system under stress. Let's now examine how financial crises threaten currency stability. Events like the 1994 Mexican Peso crisis show how quickly fixed systems can unravel. They reveal the fragility of exchange rates under pressure from global capital flows. Let's begin with the setup before the crisis hit. From 1990 to 1994, Mexico maintained a fixed exchange rate of 3.4 pesos per US dollar. This system appeared stable on the surface, but concealed growing economic imbalances. The fixed rate masked a widening current account deficit. After NAFTA took effect in 1994, imports from the U.S. surged, worsening trade imbalances. Despite rising dollar demand, the peso remained pegged at 3.4 per dollar. As pressure intensified, Mexico's central bank used its reserves to defend the peso. But with reserves nearly depleted, the government announced a 15% devaluation on December 20th, 1994. The exchange rate shifted from 3.4 to 4.0 pesos per dollar overnight. The devaluation triggered panic in financial markets. Worried about further losses, investors rushed to pull out funds, forcing Mexico to abandon the peg entirely on December 22nd. The peso rapidly collapsed to 5.5 per US dollar. By January 1995, the peso had collapsed further, losing nearly 50% of its value and reaching 7.5 pesos per US dollar. Surging demand for dollars and massive capital flight accelerated the depreciation. This phase marked the height of the Mexican peso crisis. To counter the crisis, Mexico's central bank took aggressive action. Interest rates were raised sharply from 14% to 70% to discourage capital flight. The rate hike was a desperate attempt to stop capital outflows and stabilize the peso. But the monetary response came at a steep cost. With interest rates at 70%, borrowing collapsed and businesses suffered. The country fell into a deep economic recession as the peso crisis spilled into the real economy. global institutions stepped in to prevent broader collapse. In 1996, the US and IMF coordinated a $50 billion bailout to stabilize Mexico's economy. This emergency funding helped restore some exchange rate stability at 7.0 pesos per dollar. Let's now turn to the 1997 Asian financial crisis. Across Asia, excessive debt and rigid currency pegs triggered widespread collapses. Governments were forced to seek IMF bailouts and implement sweeping reforms. We begin with Thailand, the epicenter of the crisis. From 1990 to 1996, the baht was fixed at 25 per US dollar, while banks and companies borrowed heavily in US dollars. Much of this borrowing flowed into real estate, fueling an unsustainable bubble. Soon, signs of economic weakness began to emerge. The real estate bubble sparked concerns over Thailand's financial health, prompting foreign investors to withdraw capital. Yet the baht remained fixed at 25 per dollar, creating mounting pressure on the system. The Thai central bank tried to defend the baht, but its reserves quickly ran out. On July 2, 1997, it abandoned the fixed exchange rate, letting the baht float. The currency immediately collapsed, doubling to 50 baht per US dollar. The crisis quickly spread beyond Thailand. Fearing wider instability, investors withdrew dollars across Asia, triggering sharp currency collapses. Countries like South Korea faced severe liquidity shortages and banking crises. In response, the IMF stepped in with emergency bailout packages. Countries receiving aid were required to implement harsh austerity measures and deep structural reforms. These programs were intended to restore stability, but brought significant social and economic pain. Let's summarize the key risks exposed by recent crises. Sudden capital outflows can overwhelm even well-managed systems. Poor exchange rate management only worsens volatility and panic. What makes an exchange rate system truly stable? It requires robust financial regulation, high investor trust, and credible monetary policy. Without these foundations, even the best-designed systems are vulnerable to collapse. Let's consider where the global monetary system is heading. Countries are adapting their exchange rate policies to evolving economic realities. Some advocate stronger intervention, while others lean toward market-driven approach. The IMF remains central to international monetary stability. Yet many experts argue that it must reform to meet modern global challenges. Its role is both essential and increasingly contested. What does all this mean for governments and businesses? They must closely monitor exchange rate movements, inflation trends, and interest rate policies. Staying informed is critical for navigating global financial risk. More importantly, they must be ready to act when conditions change. The ability to anticipate and respond is key to financial stability and long-term growth in a globalized economy. Let's begin by summarizing fixed exchange rate systems. Nations initially sought stability by tying their currencies to gold. The Bretton Woods Agreement replaced gold with the US dollar as the anchor, establishing fixed but adjustable rates. The IMF was created to enforce these rules and assist countries in crisis. Now let's summarize the evolution of floating systems. The Jamaica Agreement formally endorsed floating exchange rates, with some government oversight. The Plaza and Louvre Accords aimed to adjust misaligned rates. Other strategies include currency pegs, currency boards, and systems in the EU. Thank you for watching. Stay tuned for more insights from Essential Biz Marketing.